Today, we are diving into a crucial decision for business owners: how to choose between S corporations, C corporations, and limited liability companies, also known as LLCs. So, if you are starting a new business and you've been wondering which business structure is right for your business, this episode is for you. Before we jump into the specifics, let's understand the basic principles of each structure first. Both corporations and LLCs offer what we call limited liability, which means that your personal assets are typically protected against the business's debts and liabilities. These entities are also considered separate legal entities from their owners, which provides that crucial layer of protection. Now, let's talk about the C corporation, which is often referred to as a C Corp. It is one of the most common business structures. And first, we'll kind of touch on some advantages and disadvantages of this. So, C Corps have several advantages, such as access to capital through the sale of stocks, strong liability protection, and the ability to provide benefits to employees. Also, they can exist indefinitely regardless of changes in ownership. However, C Corps also come with some downsides like double taxation. Profits are taxed at the corporate level, and shareholders are taxed on their dividends. The administrative and reporting requirements are typically more complex with C Corps, which makes them less suitable for small businesses. Next up is the S Corporation, or the S-Corp. It's often chosen by small business owners looking for a balance between limited liability and tax advantages. They offer the advantage of what we call pass-through taxation, which means that profits and losses are passed through to the shareholders' personal tax returns. This avoids the double taxation that the C Corps have. And additionally, S Corps maintain that same strong liability protection that C Corps have. But there's always a downside, right? On the downside, S Corps have strict eligibility requirements. For example, they can't have more than 100 shareholders, and all of those shareholders have to be U.S. citizens or residents. The paperwork and reporting requirements can also be more demanding than some other business structures, so that's just something else to keep in mind. Now let's discuss limited liability companies, also known as LLCs. They offer a flexible and appealing choice for many small business owners. LLCs provide limited liability just like corporations, but with the tax flexibility of a partnership. This means that you can choose how you want to be taxed as a sole proprietorship, partnership, S Corp, or C Corp. LLCs are a versatile option for a wide range of businesses. Of course, there are some disadvantages. So while LLCs offer tax flexibility, they don't sell stock and they have limited access to capital. The operating agreement and management structure can vary, which may lead to complexities in some cases. And additionally, they might not be the best choice for businesses with substantial growth potential or plans to go public. So now that we've kind of touched on, the key features of each type of business, let's talk about how to choose the right one for your business. So the first step is to consider what your business's goals are. Are you looking for rapid growth and eventual public trading? If so, a C Corp would be the right fit for you. If you're a small business owner looking for tax flexibility and limited liability, an S Corp or an LLC would be more suitable for you. Next, you want to think about your ownership structure. Think about who will be involved in your business. If you plan to have more than 100 shareholders or non-US resident shareholders, C Corps and S Corps may not be an option for you. LLCs do offer greater flexibility in this regard. Next, of course, weigh your tax considerations. These are essential, and while C Corps face double taxation, S Corps and LLCs offer pass-through taxation. So carefully evaluate your income and expenses to make an informed choice when it comes to the taxes. Next, you always want to consider the administrative requirements for each. So if you're looking for simplicity and minimal paperwork, then an LLC is probably the way to go. C Corps and S Corps typically have more reporting and compliance obligations. Next, and we can't stress this enough, Always seek professional advice when you're making this decision. You don't want to make the wrong choice and then regret it later. Okay. And one thing you can do is consult with an attorney. There are plenty of business attorneys out there that can provide legal guidance to you to ensure that you're setting up your business correctly. They can also help draft operating agreements, bylaws, and any other required documents that you have to have. You can also talk to an accountant. Accountants and CPAs can help you understand the tax implications of your choices. They can also assist with tax planning and ensure that you meet all of the requirements. So, to better illustrate the decision making process, let's explore a couple of case studies. In the first one, this is a high growth tech startup. So, imagine you're starting a tech company that has a significant venture capital fund. In this case, you might lean towards a C Corp to attract investors and set the stage for an eventual IPO. In the next case, let's talk about if you're just like a small family owned business, you may want to keep things simple and enjoy tax flexibility. And so, in that case, an LLC would be a more appropriate choice in this scenario. In conclusion, choosing the right business entity, whether it's an S-Corp, a C-Corp, or an LLC, is a pivotal decision for any business owner. It involves weighing various factors such as your business goals, your ownership structure, tax considerations, and administrative requirements. Remember, this is not a decision to be made lightly. Seek professional advice, consult with your attorneys and accountants, and carefully assess your unique situation. By doing so, you will surely set your business up for success.